on your screen. Rupen Rajguru is with us, Head of Equity Investment and Strategy at Julius Baer. He's joining us right now to take some questions. Rupen, good to have you with us here. Thank you very much. Let's just start with some manufacturing, capex. One of the big things, and very visibly what is happening, is the rollout of these Vande Bharat trains. And the government is very focused that they want to do more of this, right? So 200 trains odd have been kind of put out as a block to be bid out. 120 went, then another 80 went. RVNL, of course, is one of the companies which is the beneficiary of the second lot. Have you done any work in this space? Looked at, where stocks are after the run-up, etc. RVNL used to be 40 rupees 2 years ago. So it's done very well since then. Or others in the space, the rail infrastructure space.
Hi, afternoon, Prashant. If you see a clear trend which is there for last 2 years is the focus of the government on capex side. So the two segments in which we are very clearly seeing the focus, one is the railways and second is the defense. And it all boils down to the bigger theme which government wants to focus, which is the import substitution theme, wherein they want to get the indigenous companies up the curve and get them on the manufacturing side. So all in all, I would say in particularly what we are clearly seeing a momentum because the order build-up specifically on the railway side is pretty strong. So all these stocks typically, I think as you rightly said some time back, that they do nothing for a long period of time and then they double, triple in matter of months. Because I think one of the main reason for that is the order book, right? And we are seeing that with the companies related to railways or with defense, wherein now there is a clear sign of strong order book. Earlier, the issue was on the payment cycles, but considering the overall balance sheet of the government, and then what we hear is the payment cycle is also pretty good, and hence there is no working capital issue, which some of these companies usually face when they have a long or a big order book. So net, I think it's just culmination of fact. I think right now market is looking into the order book and giving it the valuation. And I think the key for next 1 year, 2 year would be how they execute.
Rupen, I remember from our last conversation where you indicated that healthcare is a space that you've started looking at because valuations are turning attractive. In that particularly, have you gone ahead and bought any stocks in the last, say, fortnight or last 1 month in the healthcare space? And thoughts on Ipca? Is that a stock that you looked at in the process, and what did you make of that Unichem deal?
Hi, afternoon, Rima. So there is a saying which is like things are usually never as good or as bad as it appears at a particular point of time. So healthcare as a whole, as a sector, in fact, beginning of the year, when I spoke with your channel, I think it was one of our contrarian bet. Because the entire pool, the profit pool of the healthcare sector, is at its multi-year low. So from that perspective, and the stocks have done nothing, and the overall valuation of the healthcare index was lower than Nifty. So all put together, we clearly felt that there is a scope of at least some bit of mean reversion happening there. What we are seeing right now is the primary fear which people have in their mind is the how things are panning up in the US generic side. At least temporary, what we are seeing, there is some, US is facing some kind of shortages in some of those generic medicines, and hence the pricing pressure has eased off, which has helped. Some of the large companies focusing on the US generic side has seen a decent uptick in last few months. Having said that, I will refrain to comment on a particular stock because of compliance reasons. But usually, as I said, the market reaction is always, at times, is just very, very fast and furious. But give it some time for market to digest, and I think your market will find its own course. But as I said, usually the first reaction is very, very steep, and that's what probably in the stock which you mentioned we are seeing. It might not be as bad as what it appears.
All right. Hi, Rupen. Good afternoon. Rupen, there's a split verdict out there with regard to tech. What's your view? Large cap IT needs to be bought into for a longer time?
Hi, afternoon, Nigel. So in fact, what I said earlier, and if I were to put IT into perspective, 16 or odd months back, nothing could go wrong with IT, right? And I think the biggest issue in the December 2021 quarter, I think now probably everybody has forgotten, was the attrition rate and the higher salaries. The kind of salaries had gone up the roof. Right now, in globally as well as in India, now we are at least seeing layoffs and other things. What happened in IT is probably the valuations went much ahead, because the overall growth of IT pre-COVID was close to 7 to 9%. Because of COVID, probably it went to almost 13% to 18%. To mid-cap ITs, it was 20-25%. But now some of those have come kind of mean reverted, and while that one large IT company, when they revised their guidance, we saw a sharp reaction. But now what has happened is that in IT in particular, what we have to look at from a 1 to 2 year perspective, these companies' valuations are now, say, sub 20. On a FY25 basis, it might be, say, closer to 17, 18 times. And please be mindful of the fact that, while all of us are just now discussing how the Gujarat government's PSU policies have led to re-rating, all these IT companies have a payout policy. Typically, it's around 80 odd percent. So if you are at, say, 20 PE or 18 PE, and if you're paying out 80%, either your dividend yield would be more than 4%, and if you are doing buybacks, your ROEs will go up, which should command a higher PE. So net, whatever way I slice and dice, probably on valuations, these companies look much attractive now. And probably now, a lot of the companies have become extra conservative in their guidance. So that 4 to 7% guidance, probably I would say there's a high probability that they might beat the guidance, because they now want to be extra cautious because they missed the guidance. So from net, I gave a long answer, but I would say from a 1 to 2 year perspective, IT, a large cap IT in particular, definitely makes a case to be added in the portfolio.
Okay, so you are the contrarian who would look at perhaps buying some of these dips. Rupen, quick last point before we let you go today. Give us a view on consumer, because we've just started hearing from companies, and the first glance is that demand is still strong. Whether you look at Nestle's volumes or how Tata Consumer did yesterday, even Maruti for that matter, I mean, they are citing strong demand. That's why they're going ahead with a pretty big capex. So your thoughts, whether you would look to add consumer stocks to the portfolio? If so, what part of it? Discretionary, non-discretionary, autos, FMCG, you can cut it up in different ways.
Sure. Hi, Surabhi, and you're absolutely right. Consumer is a very, very vast sector. Just to add to what you said, apart from like yesterday, Pepsi globally declared their numbers, and the indication was the India business growth was in high teens. So that also the food segment within the consumer. So some of the names that you mentioned, which has focus on the food, is probably pretty strong. So staples as a sector, has usually been, and we also for a long period of time have been underweight on that sector. But now we have to see the situation. In the current context, if the global uncertainty were to go up, and while the global stock markets have been quite buoyant, but if actually there is, as they say, hard landing, and if we see the US market correcting by 5-7%, so in that scenario, probably staples would be a safer haven here. For a couple of reasons. One, the numbers are not as bad. In fact, the volume growth is good. And I think for a lot of the other companies also, the margin should also start improving because the input costs have eased. Secondly, also these stocks have seen a decent time correction. So in that context, their valuation, which was very high, is still high, but not as high as what it was some time back. So in the current uncertain scenario, probably should be to answer your question for next quarter or two, staples
Absolutely.
would be good space to hide in the current scenario.
Right. All right, Rupen, thanks so much for stopping by and giving us your view on a whole host of those sectors. Look forward to having a chat with you rather soon. By the way, when